Everyone tells you to invest, but nobody tells you the parts that actually trip beginners up. Pause 1.5 seconds. In the next 9 minutes, I'll walk you through the truths most beginners never hear. I'm going to be blunt. Sugarcoating these mistakes doesn't help anyone. If you're new, you've already lost money and don't know why, lean in. I started investing young, learned the expensive way, through trial, error, a lot of reading. Over the years, those small lessons piled up into a simple framework that prevents mistakes. Think of this as a checklist for protecting your capital, growing it slowly but consistently. I'm not promising fireworks, I'm promising practical, repeatable steps that tilt the odds in your favor. That's what beginners need more than fast returns. Trying to time highs and lows usually costs you more than it gains. I've seen otherwise smart people spend months waiting for the perfect dip and then miss the rebounds entirely. Markets don't move in nice, predictable patterns for anyone. There's a real cost to sitting on the sidelines, lost compounding, lost dividends, missed recovery runs. If you miss the best days in the market, your long-term returns suffer disproportionately. History shows staying invested beats trying to be perfect. Regular investing and staying invested beats perfect timing. Dollar-cost averaging smooths out volatility and forces discipline. It buys more shares when prices are low and fewer when prices are high. Over time, that reduces regret and often improves outcomes. If you want an action step, set up recurring contributions and leave them be. The discipline of showing up consistently matters more than guessing when to buy. You won't feel like a genius every day, but you'll build real wealth quietly. Small, consistent contributions add up thanks to compound interest. Putting $100 a month into a diversified portfolio for decades turns into a serious sum through consistency and compounding. Let's do examples. $100 per month at a 7% annual return becomes roughly $17,000 in 10 years, about $52,000 in 20 years, and nearly $140,000 in 30 years. Each decade, the curve accelerates because your returns start earning returns. The magic isn't the exact percentage so much as the discipline. People underestimate how much time does for them. Starting early multiplies results. So, don't wait for a big lump sum. Automate $50 a month. Automate $100 a month. Automate $200 a month. Treat it like a recurring bill. The habit will keep you invested, and over time the math will do the heavy lifting that extra effort can't substitute. Fear and greed drive bad decisions. Both feel terrible in hindsight. Recognize your emotions before selling in a panic or chasing a hot tip. Simple rules: preset sell thresholds, rebalancing schedules, automatic recurring investments. Rules protect you from your worst impulses. Create a checklist for emotional moments. Step away. Review why you invested. Check fundamentals. Consult a written plan. If you don't have a plan, the market's noise will become your decision maker, and that seldom ends well. If you can tolerate a 50% drawdown emotionally and financially, you're in a better position to stick with the investment during stress. That tolerance is as important as the math. Diversify across stocks, bonds, ETFs, cash to reduce risk. Diversification doesn't eliminate loss, but it smooths the ride and reduces the odds of catastrophic blow-ups that can wipe out years of gains overnight. When people put everything into a single hot stock or sector, they expose themselves to idiosyncratic risk. A diversified portfolio spreads that risk and makes recoveries easier. Think of diversification as insurance for your portfolio. Even small fees compound against you. Fee differences that look trivial in the short term can translate to huge real-dollar differences after decades of compounding returns. That 0.9% you ignored? It might cost tens of thousands down the road. A 1% management fee versus a 0.1% low-cost index fund over 30 years could easily mean hundreds of thousands less in your account. Fees are stealthy and often overlooked. Always know what you're paying: expense ratios, fund loads, advisory fees, trading commissions, hidden trading costs. Ask for fee breakdowns. Remember that past performance rarely justifies high ongoing fees. Move toward low-cost vehicles, ETFs, passive index funds, unless there's a clear, evidence-backed reason for paying more. Every dollar saved in fees is a dollar that compounds for you, not against you. Index funds often outperform most active stock pickers after fees and taxes. There's a mountain of data showing the majority of active managers underperform their benchmarks over long horizons once fees are accounted for. You don't need to be a stock expert to win. Owning broad market indexes gives you exposure to the growth of the economy as a whole. Historically, that has rewarded long-term investors far more reliably than picking individual winners. If you want higher odds of success, choose broad, low-cost index funds that track large cap, total market, international indices. Reinvest dividends. Keep costs minimal. That's the simplest path to solid long-term returns. So, trading is short-term, timing-based. Investing is long-term ownership. They require different skills, different psychology, and different risk tolerances. Trying to be both without a plan almost guarantees confusion and mistakes. Trading demands constant attention, quick decisions, and often leverage, all of which increase risk for beginners. Investing asks for patience, a plan, and the willingness to let compounding work for you over years or decades. Pick a path and align your strategy with it. If you prefer longer-term ownership, build a diversified portfolio, automate contributions, and ignore daily price noise. If you want to trade, study the craft intensely and risk only money you can afford to lose. Most people benefit more from investing than from active trading. Less stress, fewer fees, better long-term results. Okay, first, build an emergency fund. Before you invest, save 3 to 6 months of essential expenses in an accessible account so you don't have to sell investments during a downturn. This buffer prevents forced, poor decisions. Next, open a low-cost brokerage account. Pick a reputable broker with low fees, intuitive tools, easy recurring transfer options. Look for commission-free trading and low-cost ETFs or index funds to start. Then buy broad index funds, Total Market, S&P 500 International. The goal isn't to get rich quick, it's to never be broke again. Make steady moves that build financial freedom over time. That shift in perspective, from chasing quick gains to building stability, changes every decision you make. It makes you patient. It makes you consistent. It makes you less reactive. Adopt a long-term mindset. Prioritize your savings rate. Minimize fees. Avoid speculative temptations that don't fit your goals. Wealth is rarely built by luck in the short term. It's built by choices repeated over years. You'll focus on the small habits, automating, diversifying, minimizing fees. That stacks into real financial independence. If you found this helpful, subscribe for more clear investing lessons and watch our next video on building a simple index portfolio. I make these breakdowns so you can skip the costly lessons I paid for and keep more of your money working for you. Next steps. Implement the checklist we covered. Do that first, and then come back to refine allocations and tax strategies as your balances grow.